Welcome to the video on evaluating what to do with an unexpected $45,000. We will weigh the trade-offs between paying down a roughly 5% mortgage, keeping cash in a high-yield savings account, and investing in broad market index funds. To begin, we will set the stage and then move step by step through emergency fund sizing, tax-aware math, and a practical decision framework. Next, we will test your understanding with short quizzes and conclude with a concise summary you can use immediately. First, we will outline the decision landscape. Next, we will right-size the emergency fund. Then, we will compare the guaranteed return from paying the mortgage against the liquidity and after-tax yield of a savings account. After that, we will consider investing alternatives and map it all into a clear decision framework. Finally, we will run an example split of the capital, quiz your understanding, and close with the key takeaways. Before we dive in, this content is for educational purposes only and does not constitute financial, tax, or legal advice. Everyone's situation is unique, and tax implications vary by jurisdiction. Therefore, consult a qualified professional who can review your specific circumstances. With that stated, let's proceed to the core dilemma. Now let's define the problem. You have $45,000 to allocate. Your choices include paying down a 4.99% mortgage, storing cash in a high-yield savings account around 3.8%, or investing broadly in index funds. Each path has unique trade-offs: guaranteed return, liquidity, and long-term growth. To move forward, we first need to review how much cash you truly need for emergencies. Let's recalibrate your emergency fund. While some recommend 2 years of expenses in cash, that is often more than necessary and can become a drag on returns. For many households, 6 to 12 months of essential expenses is a prudent maximum that balances resilience with efficiency. Cash beyond that threshold can be better deployed toward a mortgage paydown or broad market investing. While high-yield savings accounts near 3.8% are safe and liquid, holding substantially more than your target there can represent a significant opportunity cost. In short, right-size your emergency fund first, and only then consider reallocating excess cash. Next, let's compare the mortgage payoff to leaving funds in a savings account. Comparing the two options, paying down the mortgage delivers a guaranteed, risk-free return approximately equal to the mortgage rate, about 4.99% in this scenario. This reduces future interest paid and provides psychological relief, but it also reduces liquidity, since home equity is harder to access than cash. Conversely, a high-yield savings account yields roughly 3.8%, but that rate is taxable, reducing the effective return. The HYSA shines for flexibility and simplicity. However, once we adjust for taxes and possible mortgage interest deductions, the math can narrow, though the mortgage payoff often still leads on a pre-tax basis. With those trade-offs in mind, let's quantify the effective rates. This table offers illustrative math. If you take the standard deduction, you likely cannot deduct mortgage interest, so your effective mortgage cost is close to the nominal rate of 4.99%. Meanwhile, high-yield savings account interest is taxable. At a 24% federal bracket, the after-tax yield of a 3.8% HYSA is approximately 2.89%. If you itemize and receive a marginal benefit from mortgage interest deductions, the effective mortgage cost may fall moderately, for example into the low to mid 4% range, which narrows the gap. In higher tax brackets, HYSA yields are reduced further after tax. State taxes can affect both sides. These are estimates for illustration. Consult a tax professional for precise calculations. Next, let's look at investing as an alternative to both options. Investing through broad market index funds becomes attractive once retirement accounts are fully optimized. Historically, over long horizons, equities have delivered higher returns than cash yields and mid-single-digit mortgage rates. A taxable brokerage account also offers better liquidity than home equity, though market values can decline in the short term. Therefore, avoid committing funds you will need within 1 to 3 years. Align your allocation with your time horizon. Accept volatility as the cost of higher expected returns, and stay diversified with low-cost index funds. Now, to bring these elements together, let's map a high-level decision tree. This mind map starts with the arrival of $45,000 and branches into key checkpoints. First, the emergency fund branch asks whether you have 6 to 12 months of essential expenses. If not, top it up before proceeding. Next, the retirement optimization branch checks whether tax-advantaged accounts, such as a 401k, IRA, or HSA, are maximized. contribute if not. Then, the options split into mortgage paydown, high-yield savings, and index investing. The mortgage paydown emphasizes its guaranteed return near 4.99% with reduced liquidity. The high-yield savings emphasizes top-tier liquidity, but highlights that the after-tax yield is lower than the headline rate. The index investing branch emphasizes higher long-term expected returns and volatility. A separate taxes branch reminds you that itemizing in your marginal bracket affect the after-tax math. Finally, a split strategies branch suggests that the final allocation can reflect your risk tolerance, such as a 60-30-10 blend or other combinations. Here is a practical workflow. First, define an emergency fund target of 6 to 12 months of essential expenses. If you are below that target, top it up. Second, optimize retirement accounts such as 401k, IRA, or HSA before making taxable investments. Third, compare the effective mortgage rate against the after-tax HYSA yield. Fourth, weigh your liquidity needs over the next 1 to 3 years. Fifth, select an allocation split that reflects your risk tolerance and time horizon. Finally, implement the plan, automate contributions or payments, and review quarterly to adjust for changes in rates, income, or goals. Next, let's illustrate a sample allocation of the $45,000. Here are 3 illustrative allocations. In scenario A, a balanced stability approach puts 60% toward the mortgage, 30% into a broad index fund, and 10% into cash to maintain flexibility. Scenario B tilts toward growth, with a larger allocation to index funds while still reducing the mortgage. Scenario C prioritizes liquidity by allocating more to the high-yield savings account, useful during heightened uncertainty. In every case, maintain 6 to 12 months of essential expenses in cash, keep costs low with diversified funds, and revisit your split as interest rates and personal circumstances evolve. Now, let's check your understanding with a quick quiz. Question: which option offers a risk-free guaranteed return approximately equal to 4.99% in this scenario? Options: A. Keeping funds in a 3.8% high-yield savings account. B. Paying down the 4.99% mortgage. C. Investing in a broad market index fund. D. Buying long-term bonds. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B. Paying down the 4.99% mortgage. That action locks in a risk-free return approximately equal to the interest rate. High-yield savings yields are lower after taxes, and index funds and bonds carry market and interest rate risk. Next, let's do one more quick check on emergency funds. Question: for most households, what is a prudent emergency fund target? Options: A. 2 years of expenses. B. 12 to 18 months of expenses. C. 6 to 12 months of essential expenses. D. 1 month of expenses. D. 1 month of expenses. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C. 6 to 12 months of essential expenses. This range tends to balance resilience with efficiency, allowing excess cash above the target to be reallocated to higher value uses like a mortgage paydown or investing. Now, let's wrap up the key takeaways. Here are the key points. First, right-size your emergency fund to 6 to 12 months. Excess cash can then be deployed more efficiently. Second, paying down a roughly 5% mortgage offers a guaranteed return. Third, high-yield savings accounts are liquid, but their after-tax yield is lower than the headline rate. Fourth, once retirement accounts are optimized, broad market index investing can provide higher long-term expected returns. Fifth, do not sacrifice crucial liquidity because flexibility is invaluable. Finally, consider a split strategy that aligns with your risk tolerance and time horizon. To summarize, prioritize retirement funding first. Size your emergency fund to 6 to 12 months rather than 2 years. With a mortgage near 5%, paydown is a strong and stable choice. Investing can win over the long term, but it requires a suitable time horizon and tolerance for volatility. Above all, never exchange essential liquidity for marginal gains. With that, let's close out. Thanks for watching. If this helped, please like, share, and subscribe for more content on smart money decisions. Finally, let us know in the comments how you would allocate $45,000 and why.